Okay, so we see the SPX today. It did close up after a pull down. And this is going to be for Kaushik. I'm sorry. Kaushik says November 20th, 330 put is losing money. How to repair the trade? Well, naturally, we see it's up at 3465. So my assumption is that he bought this put option expecting a decline in SPX. And well, there's two trains of thought on that, actually. I mean, okay, let's look at a couple repairs that you might consider doing, Kaushik. And we're going to use the custom spread tool for that. Now, let's just assume that you maybe paid $9 for it, sort of just out of the money or just slightly in the money as it is today at 345. So let's just put in $9 per contract. And we saw the current price, of course, we're down. That you might have a different price, I understand that. So we're here down to roughly a value of 485 on this put. The question is, could this possibly fall another 15 points with everything that's going on in the next 2 weeks? Well, the answer is possibly, right? We've got the effects of the election coming up on November 3rd. You've got a lot of companies with earnings coming up between now and expiration that could bring down the broad market. I don't know how many are actually in the S&P 500, but we still have time on this. You're losing time value, I understand. You're getting closer to expiration. Volatility is going to start to pull back a little bit more after we go through a few more earnings, and likely we go through the election as well. So you're going to see some of that decline out of it. But what is your true sentiment now, Kaushik? That's what you have to ask yourself. What is your true sentiment for the position going forward? And what I mean by that is if you still think it's possible that SPY could fall, well, I'm not saying it's going to fall down to 321. It could. Anything could happen based on the effects, or some of it might be priced in already. It's hard to tell, isn't it? But we could see a further decline with what's coming next week with some other earnings, and of course, the effects and the outcome of the election on November 3rd. We still have 16 days to go in that case. All right. But you're kind of losing value right now. Well, you could change your break even. Okay, so what is one aspect that you could do to change your break even? You could try to roll down the put to a lower strike price, or a higher, you could roll the put to a higher strike price. It's going to add cost basis to the position, increase risk, but you might be able to lower your break even. My example right now, your break even's at 321. So what happens if I just get what I can for this put right now? We go ahead and sell our 330 put, and we buy something that's more at the money if we're still expecting a decline. Okay, so we're going to add to the cost basis because we paid 9. We're going to take 485 back, or 487 back roughly. And then we're going to buy the higher strike put. And in this case, it drops the break even to 332. Okay, so even though now you're exposed to 1381 cost basis, because you increase the strike at this point, where we've come up to a higher level, we've pulled down a little bit, but then we've come up to a higher level, then you're in a position where you've at least changed the break even to where you only need the underlying to fall to 332 now, as opposed to 321 if you leave the current position. Now, could you simply just sell a put against your long put to reduce the cost basis? Yes, but which direction? Do you want to create sort of a bull put credit spread because you think SPY is now going to continue up, or do you want to create a bear put debit spread because you think it's going to go down and that premium will help you? So we're sitting here at 330 and the stock's at 345. And if you're still bearish on the position, then of course what you could do is sell a lower strike put. That's going to lower the cost basis onto the position, give you a better break even. Remember, 321 in this case. Let me just go ahead and submit that so you can see it, Kaushik. 321 in this case, but now to get the full profit, you'd need the stock to fall further. So to create a true bear put debit spread, I have to sell the strike that's lower. If I sell it higher, I'm creating a bull put credit spread, which may work out. We'll take a look at that in just a moment too. But if you still think the market's going to fall and you're looking to hedge, well, maybe in this case I could sell 325 for about close to 390, but not quite, about 388 or so. So just 5 points away, we're going to collect another 388, which is going to do what? Well, didn't quite get us to a profit. Why? Because I have a debit of 511. And I only have a 5-point difference in strike prices. Did I reduce my risk? Yes, I reduced my exposure, but now there's no chance to win. I could maybe only lose 11 cents if the stock was trading below 325. Didn't hit your current break even of 321, but you're only losing 11 cents in this case. If it hits to 332, where we saw that other break even by adjusting the put, if you still have that bearish sentiment, then at roughly 330, 332 at expiration, we're looking at a loss of, oh, I'm sorry, the 511, right, because we're holding the 330 put, okay? So where that first one of rolling it down would get us to break even at 332, this hedge would still give us a loss with no chance to potentially win. It's the bearish structure, okay? Now, if you think the stock's going to stay up, maybe above 335, you could hedge some of this loss, of course, by doing the opposite, selling the 335 put to create a bull put credit spread, hedge some of the cost, but you're not going to get $9 for that 335 strike. So you're going to be in a credit spread, just like the debit spread we just saw, that's guaranteed to lose. All right, we'll take a look at it just because we're here. We want to go through all of the different examples that are possible. There's many that are possible that we won't get into. I don't want to get into anything too elaborate of trying to convert this to a double ratio back diagonal spread or something along those lines. Okay, but you can see here, if I'm in a bull put credit spread and I paid 9 for this and I'm getting 6 for this, well, that doesn't work. That's not going to get me to a profit. In fact, I'm going to be locked into a $3 loss, even if the stock stays above 335 in that case. All right, so yeah, 290, 150 roughly with the midpoint prices there. So that's not really a good structure. Now, what I think might be the better structure, depending again if you're bullish or bearish. Are you slightly now bearish? Are you slightly now bullish? That's what you have to answer for yourself. I think, to keep it simple, and I know this is a little bit complicated, but to keep it simple, I think a good idea, we'll get into something more advanced in a moment. I think a comment just came in regarding to something more advanced here. I think doing that approach that we talked about first, I think I used the 346 put, I don't remember. But in any case, it's close to it. Yeah, okay. So remember that first scenario. We sell to close this existing put, we get $4 back. We buy another put at 968, but 16 points higher, slightly in the money to where SPY is right now. All right, that gives us a better break even at 332. And a huge risk, though, of 1379. That is going to be a problem from what I was looking to do. What do I mean by that? Well, if I do think the stock is possible could drop down to 335 or lower, could I reduce some of this cost basis by now creating the bear put debit spread? And the answer is yes. But I don't know if we're going to get $3 for that put, selling it, and the 10 or 11 points that we'd get if it was below 335. So in the debit spread, when it's below both strike prices, in this bear put debit spread we're going to look at, we effectively close out the position and get the $10 difference in strike back. Are we going to reduce it to below 10 points with the cost basis? Well, let's take a look. We're again going to say that if we think that it might hit 332, that means it might hit at least 335. It's 11 points away from where we are now. So I'm going to consider selling that 335 put. And I think this is going to work for us here because it's priced at about 607 in that case. So we've rolled the put up to an at the money, slightly in the money strike, really at the money, probably as at the money as we can get. we're still bearish on it and think it could pull back maybe 6, 7, 8, 10 points. I'm not saying this is my recommendation. I'm saying that if you still have the bearish sentiment that by November 20th, after the next cycle of earnings that lead up to the election on November 3rd, the static fall of this position could take it back down to 335 or 330, a continued downturn in this case. It's not too bad at all. We lower the debit to 771, which is what? Less than the original exposure. Now, I am basing this on a cost basis of $9, Kaushik. I'm sorry. If your cost basis is 10 or 11, you'd want to use the power options tools here to run the numbers to see what the new cost basis would be, only getting 487, 488 back for your call. Sorry, your put that you currently have. Buying the new put at 968 and then creating a bear put debit spread here. But in my example, we've lowered the exposure from $9 down to 771. And if the stock is below 335 at expiration, we'll have a profit of 329 against a risk of 771 or 42.7%. Essentially what happens if it's below 335 is you'll buy shares of SPY at 335, your broker will exercise your 346 put, and you'll get the $11 back. Okay? But the break even is also nicely adjusted too. It's only at 338. It's only 7 points away on November 20th expiration. Why 338? Well, remember, I've got a cost basis of 771. 771 minus the long put strike of 346. It's going to be 338.29. So if the stock's there, what happens? My 335 put expires worthless. And I can sell to close my 346 put that I rolled up to, same expiration to keep it simple, not extending it necessarily, because we have these known events coming up with unknown outcomes. So it might work in your favor, it might not. And that's the risk here. That's why you're just having to decide if you're bullish or bearish in this situation. But this adjustment of rolling up the put, increasing cost basis, but then maybe creating a bear put debit spread if you're still bearish, lowers your exposure by about $129 if your original cost was around $9, of course. Gets you to a break even of 338.29 instead of 321, where you are right now with your 330 put, and a reasonable return on the risk exposure, but it is capped. If for whatever reason SPY dropped down to 320 or 315, you're not making more than the 329 against the 771 exposure, 771 risk in that case. So those are some of the simple ideas. Didn't like the bear put debit spread, although if it did fall, as we saw, you did limit your exposure. You did get a better break even at 332. Remember that first one we did where we were selling the 325 put, I believe. We lowered the cost, but even if it fell that far, we were still at a loss of 11 cents. It wasn't getting to a profit. I'm sorry, I think it was the 325. That's what I said. Rolling it up to the at the money strike now puts you at a cost basis, break even of 332. Again, folks, based on if your cost was $9, you'd want to run your own scenario there in that situation. But we rolled up to the at the money strike at 346. That put our break even at 332, much more manageable than 321. But it increased our exposure to 1,300 if SPY kept moving up above 346. Okay. Now, once we rolled up, then we looked at the bear put debit spread again, 10 points apart, cut our cost basis almost in half from the 1,300 to 771, but still lowered our initial cost basis in this example, and gives us a better break even at 338.29 if you're still expecting the market to potentially decline in that case. So that is something that you may want to consider as well. Now I'm going to clear this all out again, and we're going to start from scratch. And it wasn't the comment that I thought came in. It was a little bit different. But the comment was, could you use this to create a Condor or some kind of ratio back spread? Well, see, here's the problem. To create an iron Condor, it's a combination of a bull put credit spread and a bear call spread. What did we see here? Because of the cost we likely paid for this, unless we went really high to in the money with the puts, we couldn't get this left side, this bull put side, to a credit because we need $9, right? So the 345 at the money would be the best one. But if Kaushik's, that would create a bull put credit spread between 345 and 330, a 15-point spread, and then he could do the bear call side. But if Kaushik is still sitting on an idea that the stock could fall, it just won't fall to the 330 level he needs or the 321 that he potentially needs, then he's going to be in a loss area with his 345 put sold. It doesn't solve the problem of still taking a loss if it moves in his right direction. Okay, so that's the danger of creating the Condor in this case. And you wouldn't be able to get enough premium to hedge it both. But let's just see. So I need $9. But let's say I know I'm going to get something for the credit. So let me go $8. Let me go to 342. And that's a 12-point spread. But on the bear call side, I'm going to do something a little smaller. Let's go to 355. I want to go half. So 355 is at 420, 425. 425, 428. So yeah, half would be about 210. 361 is close enough. Okay. So what am I doing? I'm creating a bull put credit spread here by now selling the 342, which is pretty close to this strike. I'm not giving myself a lot of breath with these known events coming up with unknown outcomes. And then I'm going to enter a bear call credit spread by selling a 355, only 10 points away, and buying a 361. Because of the $9 cost, it only gives me 122 net credit. My break even is 340.78. That looks really good. But remember what I did with the bear put debit spread. That break even that I was trying to move up was where we would get to the profit. Here is the only level of profit between 340 and 356. The stock at 345. That lower window of 5 points is very small. Okay, it's a very small window with everything that could happen in the next 14 days, 12 days, 11 days to the election, the effects after the election, and then you only have 17, 16 days to go to expiration. That's a very tight window in my opinion. And the risk exposure is higher. And it's down here. It's that if SPY did now fall below 330, we'd be at the max loss on that 15-point side, 12-point side, excuse me, from 330 to 342 on the bull put side. And that would be kind of tricky. I don't think this is the right structure in this case. Again, with the known events coming up with unknown outcomes, that this 5-point window might be a little bit too tight. I think that if Kaushik does still have a bearish sentiment, that rolling that put up that we discussed and then maybe turning it into a bear put debit spread and getting the risk up to 338, the break even, I'm sorry, 338, where anything below 338 was the profit, not entering the loss zone, is where we want to be. But again, that's if there's still a bearish sentiment. If there's a bullish sentiment, we might want to do something completely different in this case. Might be risky, but when we talked about how trying to sell those higher strike puts in that case to try to pay for the $9 and get a credit, we'd have to go in the money to do that, and that might be a little bit risky, especially if it starts to pull back. So based on your sentiment there, I don't think this is a very stable, this is a wise position with everything going on and the changes in volatility we're likely going to see in this case. It does give you a potential profit if SPY stays in this 16-point range to November 20th, absolutely. But if you still have a bearish sentiment, that bear put debit spread we created by rolling up the put, selling that lower strike put there, gets you to a break even of 338, not that bad, not too bad at all. I'm sorry, 338, not too bad, 7 points away, a little bit of a move, of course, but not too bad. And in that case, it would do that. And this is, Bot says, I'm sorry, Kaushik says, what about converting to a butterfly? Same thing. If I converted this to a butterfly, I'm only going to be getting a credit of maybe $1.50 or $1.60, and my upper to lower break even are going to be tighter. That's what the butterfly does. Okay? It would be very difficult Well, we'll do it, but it's the same thing. You're still expecting a movement with these events coming up, earnings and the election. One way or the other, it's going to move. The butterflies and the condors are the exact opposite structure that you want to be in if you think your underlying is going to move from a known event coming up with an unknown outcome. Earnings, the effect of earnings on SPY, they may be big or small. Most likely they'd be very small, but it will move SPY. And then, of course, again, on the other side of that is the election. Okay, so whether it moves up or down, both the butterfly and the condor are not conducive to moving up and down. They're the most neutral things you can do. But let's take a look at an all put butterfly. So you're already in to this 330 put, excuse me. All right, so that's still hanging out there. And then what am I probably going to do? I'll probably sell 2 of these. I don't know. I don't think I'm going to keep the strikes the same. We're going to do a different wing, of course. But this is going to give me about 18. Can't get 9, can I? Unless I'm 1 point away. That's going to give me close to 19. You see what we're looking at here, Kaushik? How it's not even in the eyeball, it is kind of difficult. Why? We're going to get about 1940, 1938 for this. We already paid 9. So I've got a credit of only 1038. And this is just below that. Everything else is higher. Okay, but we could get the debit if it stays down below. So 6 points. I don't want to go 10. I don't want to go 5. All right. So we'll go, let me just go 7 points. Let me go to the 353. That's going to take away the credit on the position. So, I mean, I know these butterflies, these all put or all calls are done at a debit. I understand that. But let's now sell 2, buy 1. It's going to be a little broken wing. We're only 7 points here and we're 16 points. Maybe I should have done half. Maybe I should have done 8 just to keep it even, but we'll take a look at this one. Yeah, okay. 341 to 350. What did I say? Much tighter, upper and lower to break even. Okay, just 5 points up, just 4 points down before you start losing money on the position. 438, investment of 262, but your max requirement on the bull put side is 1600. Okay, so that's why it's only 23%. Your cost, your debit is lower to 262. But the max you can lose on the downside, again, if it falls to 330, is that 1600 plus the 262. So it's 1862. I'm sorry, 1162. That's right, because you get the debit back. My apologies. You get the 7 points back, the 700 back from this 7 point spread. 341 to 350. Election coming up, series of earnings coming up next week. The market's going to be moving up and down and up and down. The butterfly to me is not the right solution with the events coming up. That's me personally. If you think, Kaushik, that it's going to stay in this range in the next 40 days, right? 38 days with the election and with earnings still coming up and more earnings after the election as well. Right? We'll still be going through an earnings cycle at that time. If you think it's going to stay in this range, then yeah. But to me personally, with everything that's coming up and trying to convert it to a short strangle, trying to convert it to an iron condor, which we saw had a tight upper and lower break even because of that higher cost of the long option that we're losing on right now. That's being factored in. Or any type of butterfly or broken wing butterfly in that case, when you're expecting the market to still swing one way or the other from an unknown event, that could still potentially, you're still potentially putting yourself in the condition for losses. And some of them are higher than what you take right now if you lost the full amount on the put you bought. Again, assuming that put costs $9. Okay. And you could try to run different scenarios, but remember, the more in the money you go for the higher premium, you're not collecting more time value, you're just collecting intrinsic. So if I went up all the way to the 360, I'm going to get a much higher premium here. I'm going to increase the strike differences, but most of that premium is going to be all intrinsic, not time value. And I need the time value to give me this credit to bump me up here, to give me that little peak for the potential profit. Okay. So that's sort of the risk we're looking at here. And that's why in this situation with what's coming up, Kaushik, with the earnings, I'm not saying I'm expecting it to move up or down because I don't know the outcome. What I'm saying is that I don't think any position that puts you in a neutral bias, and the most neutral things you can do are short straddles, short strangles, iron condor positions, the iron butterfly position, or any combination of an all call or all put condor or butterfly. These are the most neutral things you can do, and you don't want the underlying to move, period. But it could get you to a repair if and only if it stays within these shorter windows. That's why I said that I think if you have still a bearish sentiment, I did like the idea of rolling up the put, converting it to that bear put debit spread where you have a break even now of only 338, and anything below 338 or below got you that profit of whatever it was, 300 on 771, or close to 42%. So I think that was a stronger repair if you're still bearish on the market and still expecting a movement after the election. If you're expecting the market not to move at all with the remaining earnings coming up in the next 3 to 4 weeks to November 20th, and you're expecting the market's not going to move that much at all based on the outcome of the election on November 3rd, maybe the butterfly or the condor repair would work for you. But I'm expecting more of a move after that, and I don't think it's the right structure to be in personally. But your sentiment could be different, and this could be a viable repair. You're absolutely correct, Kaushik. Don't get me wrong. If that is your sentiment with everything that you know is coming up in the next 2 to 3 weeks. All right, before expiration. Okay, so that's our discussion there on the 330 SPY put that's losing in value. We used a cost basis of $900. It's currently at about $448. We ran through examples of trying to do a debit spread first or converting to a credit spread that didn't get us where we wanted. So we talked about rolling the put up, creating a debit spread at that point based on if you're bearish sentiment or if you're bullish. And we looked at those more elaborate repairs of creating a butterfly or creating a condor. But again, puts us in the neutral position in that case. And the neutral position might not be the structure that we want here going forward with our known events in the near future. So going back one more time here, let's take a look at our 330 put. I'm going to keep my price at $9. Okay, so earlier, as many of you recall, we were talking about this long put on SPY. Kaushik bought it 330 put for, and I used a price of $9, currently at about $485. Not a 50% loss yet, but close to it. Getting closer and closer. I missed this in the previous discussion, Kaushik. It happened as I had moved into Bill, and we showed the idea of rolling up to the November 20th, 346 put, which moved the break even, from 321 up to 332. Then we created a bear put debit spread, which moved the break even up to 338 if you still expected it to pull back in that case in the unknown market. This is what I normally might suggest. And Kaushik says, can we get more time value by rolling the expiration further away? Absolutely. You could roll the 330 all the way out further in time, or roll up to the 346 further in time. But what's that going to do? That is going to cost more money. You're going to pay into more time premium. I know you know that, but you could do it. My assumption was, as you had bought this 330 put, at some point, whether you were following the market sentiment indicator and you were using this as a hedge or just using it as a small gamble, of course, to when you saw the sell warnings come in, or you're playing the election thinking that with the earnings that were coming up during the pandemic in this quarter and the election coming up 4 or 5 days after a lot of big companies, or 2 weeks after a lot of big companies reported, that you'd see a bearish move. We haven't hit those events yet. So that's why I was tempted to stay with the November 20th expiration, to keep the cost and the time value a little bit lower, and to go through those two events. Now, come November 4th, November 5th, whether you keep it as is, whether you just roll up to the 346 put, or whether you create that bear put debit spread because you're still slightly bearish, if you're not seeing the move you expected 1-2 days after the election, now you might consider moving that put further out in time if you're still bearish, or maybe taking the loss on this one and going into a long call position if you think it's still going to move up as well. But yes, rolling further out in time will give you more time value, but it's going to increase the cost. You know that. I know you know that. More than just rolling to the expiration that you're in. And my assumption, and yeah, and I shouldn't make a lot of assumptions here, but the assumption was that you were in this time frame so that you could cross through most of the big earnings and the election, and you had a bearish sentiment. That's why this position would have been opened. Or if it was as a hedge in case the market did fall against spread positions or other bullish positions in your portfolio. I see that. And you hadn't mentioned that. But if this is the structure that you point me to and say, I'm bearish here. I expected SPY obviously to be below 330. I expected it potentially to drop to 321. And it was probably targeting around the events coming up. Then you can still stick with the 20th with the adjustments we showed to get you to a better break even of 338. That was with the bear put debit spread, or 332 by just rolling up the put. And then if you don't see the move that you want, because of this event coming up, which could influence the market, and I thought that's why you were likely playing this, then you might want to consider it moving further out or changing direction if your sentiments change completely as well. But yes, absolutely, you can roll it further out. I was just going to think to cross the date, cross the event, Kaushik, before doing that as well. And Fernando brings up a good point, and it's similar to volatility. Of course, it is volatility, but Fernando says rolling the put far out in time is going to expose the structure to more vega due to the elections. We are going to see some volatility fall, of course, vega change as well after that election event. And that's why I was saying sticking with November 20th, because it's not going to be, it's going to be affected greatly. Don't get me wrong. It's going to be affected greatly by the election event. But going further out in time now, I think that you still might be able to hold through. I think you want to make an adjustment perhaps, but you still want to hold through to the event that you were targeting originally. You still have time, and the market's going to have its eyes on that, and it's going to have its eyes on the earnings that are coming up between now and then.